By the end of 2019, China's total debt had surpassed a staggering $40 trillion, a number so large it's difficult to comprehend fully. This debt, which is spread across various sectors, including corporate debt, local government debt, and household debt, makes China the most indebted major economy in the world. But beyond the sheer scale of this debt lies a much deeper question. How does China's debt affect the global economy? And what risks does it pose to the future? The story of China's growing debt begins with its meteoric rise as the world's second largest economy. For decades, China's economic growth was driven by state-led investment, massive infrastructure development, and an export-driven manufacturing sector. This growth, however, was accompanied by a steady increase in borrowing. As China's economy expanded, its reliance on debt to fuel further growth deepened. While this debt was initially manageable, the scale of it began to raise alarms as China's financial system became more complex and interconnected with the global economy. To understand how China's $40 trillion debt affects the world, we must first break down the structure of its debt and who holds it. China's debt is divided into several categories: government debt, corporate debt, and household debt. Each of these categories has distinct implications for the Chinese economy and its position in the global financial system. Government debt. China's government debt includes the national debt issued by the central government, as well as the debts accumulated by local governments. While the central government's debt remains relatively manageable, local governments have faced growing financial pressures as they sought to fund infrastructure projects and economic development. To finance these projects, local governments in China have increasingly turned to borrowing. In 2019, local government debt alone was estimated at more than $7 trillion. Much of this debt has been used to finance infrastructure projects such as high-speed rail, highways, and urban development. However, many of these projects are less profitable and could become a burden on the economy if they fail to generate sufficient returns. The local government debt is particularly risky because it's often not officially recognized in China's accounting system. Local governments often hide their borrowing behind so-called off-budget funds, making it difficult to track and evaluate their financial obligations. This lack of transparency has raised concerns both within China and internationally, as it adds a layer of uncertainty about the true scale of China's liabilities. Corporate debt. Corporate debt in China is the largest portion of the country's total debt, accounting for roughly 160% of GDP in 2019. Chinese corporations, particularly in the real estate, construction, and manufacturing sectors, have relied heavily on borrowing to fund their rapid expansion. One of the most significant examples of corporate debt in China is the real estate sector, which has been one of the key drivers of economic growth. Companies like Evergrande, a real estate giant, have amassed massive amounts of debt to fund their projects. But the problem with this is that the real estate market in China is facing a downturn, and many of these companies are now struggling to service their debt. The high levels of corporate debt in China are particularly concerning because of the shadow banking system, which allows companies to borrow from non-bank financial institutions that are not subject to the same regulatory oversight as traditional banks. This system has led to the accumulation of risky debt that is not properly accounted for, which increases the potential for financial instability. If companies like Evergrande default on their debt, it could lead to a domino effect, impacting other businesses and financial institutions, both within China and globally. Household debt. China's household debt has also increased dramatically in recent years. As China's middle class grew, so did its spending power. The Chinese government encouraged consumer spending as a way to transition from an export-driven economy to one based more on domestic consumption. This led to an increase in household borrowing, particularly in the form of mortgages and consumer loans. By 2019, China's household debt-to-GDP ratio had risen to over 50%, up from just 18% in 2008. While consumer borrowing is still lower than in many Western countries, it has raised concerns about the ability of households to repay their loans. The rapid rise in household debt could lead to rising defaults if the economy slows down or if interest rates rise. Additionally, as housing prices remain high, many Chinese families are heavily leveraged, making them vulnerable to economic shocks. The global implications of China's debt. China's debt has significant implications for the global economy. As the world's largest exporter, China's economic health is directly linked to global trade and investment flows. If China's debt becomes unmanageable, it could lead to a slowdown in its economy, which would have ripple effects throughout the world. A slowdown in China would lead to lower demand for imports, affecting countries that rely on exports to China. Furthermore, China is a major investor in global markets, with significant holdings in U.S. treasuries, European bonds, and other assets. If China is unable to service its debt or experiences financial instability, it could lead to a sell-off in global financial markets, increasing volatility and reducing investor confidence. China's debt is also becoming more risky because much of it is denominated in foreign currencies, particularly US dollars. While China holds a large amount of foreign currency reserves, if the value of the Chinese yuan were to fall, the cost of repaying dollar-denominated debt would rise, putting additional strain on the country's finances. Moreover, as China's debt increases, so does the amount it must pay in interest. In 2019, China's debt servicing costs amounted to approximately 8% of its GDP, a significant portion of its national income. The debt trap and China's credit rating. China's growing debt also raises questions about its ability to maintain its credit rating. Despite the country's impressive economic growth, China's debt levels have led to concerns among credit rating agencies. In recent years, China's credit rating has been downgraded by major agencies, including Standard & Poor's and Moody's, which warned that the country's rising debt was a significant risk to its financial stability. If China's credit rating continues to fall, it could lead to higher borrowing costs, further exacerbating its debt problems. Furthermore, China's debt trap diplomacy has raised concerns globally. China has increasingly lent money to developing countries as part of its Belt and Road Initiative, which aims to build infrastructure across Asia, Africa, and Europe. While these investments have helped boost China's economic influence, they have also resulted in several countries being saddled with unsustainable debt. In some cases, countries have been forced to hand over key assets to China in exchange for debt forgiveness, raising concerns about China's growing geopolitical influence and the risks associated with its debt-driven diplomacy. China's debt crisis and the risk of global instability. As China's debt continues to rise, the risks of a financial crisis grow. The country's economy is showing signs of slowing, as its once booming property sector faces significant challenges. Additionally, China is facing an aging population, which could put further pressure on government spending and increase the cost of servicing its debt. If the Chinese government is forced to bail out struggling state-owned enterprises or local governments, it could further exacerbate the debt crisis. Moreover, the ongoing trade tensions between China and the United States have created a sense of uncertainty in global markets. As the US and China engage in a trade war, the global economy becomes more fragile, as tariffs, supply chain disruptions, and shifts in investment patterns have a ripple effect on markets worldwide. If China's economic growth falters, it could lead to a slowdown in global trade, further exacerbating the economic challenges faced by many countries. Conclusion. The future of China's debt. China's $40 trillion debt is a ticking time bomb, and the country faces a delicate balancing act in managing its financial obligations. While China's rapid economic growth has lifted millions out of poverty, its reliance on debt to fuel this growth has made it increasingly vulnerable to financial instability. The implications of China's debt crisis extend far beyond its borders, as the global economy is intricately linked to China's financial health. The future of China's debt will depend on how effectively the government can manage its obligations while addressing the structural issues that have led to the accumulation of such massive debt. China's financial system is deeply intertwined with the global economy, and any significant economic downturn in China will have far reaching consequences for global trade, investment, and financial stability. The global chess game surrounding China's debt is one that will continue to evolve. As the country navigates its debt challenges, the world will be watching closely. The stakes are high, not just for China, but for the entire global economy.